Welcome to back to our Chapter 2 video lectures. In this lecture, we're going to cover Learning Objective 5. We finished our Learning Objective 4, noting adjusting entries such as prepaids, accruals, and estimates. We're going to continue our discussion of prepaids. So here we have the cost of assets that we acquire in one period, but we can expense them throughout future periods. So in our adjusting entries, right, we would have the fact that we're recording our expense and we're reducing our prepaid expense. Do not forget that prepaid expense is an asset. So when you actually record it, you would say debit prepaid expense and you would credit cash for the amount, let's assume $1,000 here. Then when you actually incur the expense, right, so usually through the passage of time, you're going to debit, let's say, you're going to probably debit some type of miscellaneous expense for $1,000, and then you're going to credit the prepaid expense account, right? Because you've recorded it here, now you're going to eliminate that asset. You do not record cash again. You have to make sure that you liquidate, if you will, or zero out your prepaid expense. So our example here, we have a trial balance and we have supplies of $2,000 that we purchased, and now we determine that at the end of July there's only $1,200 of the supplies that remain. Therefore, you are recording $800 of supplies expense and you are recording $800 to the supply account. Note on your exam, I try not to use supplies because supplies is usually expensed outright in industry. We normally don't do this process, but it's just a good example in your textbook. But usually when you purchase supplies, since they're usually a small amount, you expense it right when you purchase it. And then you see the T accounts for both supplies and for the supply expense. So another one that we have is basically we paid $2,400 to the landlord, and that's for 1 year of rent. So usually then you would take $24,000 and divide it by 12 months because we are recording monthly expenses, and you would hopefully get $2,000 in this case. And here you're going to record the rent expense for $2,000 and you're going to credit prepaid rent. Now remember, when you actually purchased you actually gave the money to the landlord, you would have debited prepaid rent for the $24,000, and then you would have credited cash. And remember, always think about what happens to cash. So here's your prepaid rent that you actually set up, and now you are reducing it by $2,000. So when we look at the T accounts, we have $22,000 in our account, and this you would usually have a reconciliation that you would do at the end of the month to make sure that that balance is correct. An additional example is we have furniture and fixtures of $12,000 that were purchased during the month of July, and the furniture and fixtures have a useful life of 5 years or 60 months, and that's just 5 times 12 equals 60, and it would be worthless at the end of that period. So our worthless is actually showing us our salvage value, right? So in this case, salvage value equals 0, which is very common in our accounting. So basically we have our 60 months at $12,000, so that gives us $200 of depreciation expense. And notice we hit accumulated depreciation. We do not hit the furniture and fixtures account. The property, plant, and equipment or fixed assets account are only debited when you add assets, and they are only credited when you remove assets or dispose of them. So if you are recording depreciation expense, you have to debit depreciation expense and you credit accumulated depreciation. Accumulated depreciation is a contra asset account, and as such, it has a credit balance. So accumulated depreciation has a credit balance. So make note of that. So it's our contra asset account. So here's a concept check. So if you work through this problem, you will see that we have prepaid insurance of $1,400. We paid an additional insurance premium of $1,100. And the amount of prepaid insurance was correctly shown at $1,000. So the amount of insurance expense that should appear is basically, hopefully you've entered $1,500. So the easiest way to do this, in my opinion, is through a T account. So here we have prepaid insurance, and we know that that's an asset. And so we have which shown on the company's balance sheet as $1,400. So that's our beginning balance, and we know that's a debit. And then we paid an additional insurance premium of $1,100. And then we show that our ending balance is properly recorded at $1,000. So basically, if you add these two, you get $2,500 minus $1,000. So you know that it would be $1,500. Also, how you could do that prepaid insurance is you have beginning balance plus additions less deletions equals your ending balance, and we normally add for premiums and we delete for an expense, or we remove for an expense. So you'll know that the credit is on the expense side. So that's a great way to solve for prepaid expenses. Now, our deferred revenues is basically when we get cash from customers in advance and then we provide the goods and services. So basically, this is an obligation for us as a company to provide those goods and services, so that's a liability. So basically what we do is when we get the cash, we debit cash and we credit probably deferred revenues for an amount. And then as we see here, when we actually record it, we are going to now debit deferred revenues for the amount, and then we are crediting revenues, sales revenues or goods, sale of good revenues. So this is the entry to record the cash when you receive it, and this is the entry as depicted here that shows you actually earning the revenues. So we'll go through several examples. In this case, we subleased a portion of the building to the jewelry store for $500 a month, and the jewelry store paid us $1,000 in advance for the first 2 months. So in this case now, we are booking our journal entry at the end of the month. So when we got the $1,000, we did debit cash for $1,000 because we received that from our sublease, and then we credited deferred rent revenue for $8,000. So now we are actually taking that deferred revenue and we're booking it. And I believe we paid $1,000 in advance for the first 2 months, and I made a mistake here. This should be $500. Sorry about that. And then we see the balances, because basically we're saying here that we have $500 per month and we paid 2 months in advance. So make note, change these amounts. I made a little boo-boo here. Sorry about that. Moving on, now we have another process here, so you can work through this example and we can see as well that we'll come up with the balance, and then you see beginning balance, additional receipts, and subscription revenue. Same thing like we did, right? So we would have beginning balance, additions, and then here we would earn the revenue to get our ending balance. So subscription revenue deferred. All right, so there's other ways that we can record prepayments and expenses, and you can actually hit rent expense and cash. I do not recommend doing this. This is not really conservative, and it's not really the way that we do it in business. So I would say I'm presenting it here just so that you know that there's another way to do it, but the preference is to record the cash directly to prepaid rent and then incur the expense as the passage of time goes through. And the same thing for deferred revenue. You do not record the revenue first. You actually record it to deferred rent revenue. But I wanted to give you the opportunity to see the various approaches. But the recommendation is to use our first approach, and that's what's normally used in business. I never, in all of my controllership jobs and my CFO job, never did it in this fashion. So accruals involve cash flows after you've had the expense or the revenue recognition. Liabilities is our most common accrual, accrued liabilities. And basically that's usually involving external transactions that are recorded from a source document, and then sometimes it may generate from internal transactions. And basically what an accrued liability represents is a liability when an expense has been incurred but you have not yet paid the cash, again to bring us to an accrual basis of accounting. So in this case, you haven't paid the cash yet, so here you're recording the expense and you're crediting the liability account. So you have to record the expense because you incurred it, and then you have to record the liability showing that you owe the money at some future time. So some examples of that is basically we paid employees $5,000 for salaries for the first half of the month, and we're assuming that the salaries for the second half are going to be $5,500. So in this case, we have to record the salaries expense because maybe, the pay date isn't on July 31st, but August 3rd, so you have to record in July the fact that you incurred the expense of $5,500. So salaries expense would be debited and salaries payable would be credited. And you see the T accounts in this fashion as well. Then another example is the notes payable account of $40,000. We borrowed this amount on July 1st, and we had the two notes and each requiring payment of 10% interest. So remember, interest equals principal times rate times time. Hopefully you remember that from finance. If not, make sure you make a note of it. So in this case, since we got it on July 1st and we are doing these entries for July 31st, we have 1/12 of the month. So we have to record the accrual of our interest expense for $333, and that we do pay that interest. And you accrue this every month, and you might pay the interest quarterly. So here's a good concept check again with interest, and you will see just as we calculated previously, again, interest equals principal times rate times time. So here's principal, rate, time, and then our interest. So it's a very easy formula. Now for accrued receivables, here revenue is recognized prior to getting your cash. So again, you're debiting a receivable, an asset, and then you're crediting the revenues. So in this case, we loaned $30,000 at the beginning of August and by a note, and they're giving us the terms of the note. So we have principal, rate, and time to get our interest. So here we're expecting to receive this interest, and now we've earned it during this period. And estimates is our last and third classification. Usually depreciation expense is the most common, and bad debt expense. So remember, we said we're going to debit depreciation expense and we are going to credit accumulated depreciation in our case here. And for bad debt expense, you are going to debit your bad debt expense, and then you are going to credit allowance for doubtful accounts. Also a contra asset account. So then after you've adjusted your trial balance and all the entries have been recorded, you have an adjusted trial balance, and this is the form where you need an adjusted trial balance to prepare your financial statements. So here's how your adjusted trial balance will look, and remember, this is where you prepare your financial statements and note your debits equal your credits. And then we see our unadjusted trial balance. If we look at it, so we've actually added several entries to this, including our prepaid expenses, our accruals, our accrued liabilities, and also our estimates. Great, this concludes our video lecture for Learning Objective 5 of Chapter 2.